stock staging a big comeback today. Let's bring in Solstein Capital CEO and founder Nadine Terman. Nadine, 3 words that you keep saying. Cash is king. Tell us why.
Well, Frank, we like to tell our clients that outrunning a bear by yourself is difficult, so let the other investors get caught up on a day like today and go first. When the volatility index of the VIX is above 31, we call the market uninvestable. So one of the best things you can do is hold some cash and be patient as you get more asymmetric opportunities.
So Nadine, you say be patient, but do we also want to be defensive, or should we try to look at this rally as a buying opportunity?
We tend to get defensive. So I, along with most people, probably have some of those stocks you should have sold 2 months ago. And so today's a perfect day. Last week was a perfect opportunity. You can trim some of those positions and then take advantage of the opportunity to either short, add cash, or get defensive positions, such as one of our favorite gold companies that was down today, to be able to pick up some of your more favorite exposures.
Hey, Nadine, I'm with you 100%, by the way. I understand what you're saying, and thanks for being here. Here's a question just to play devil's advocate. We could be in an environment, I say, where, the VIX just sort of bleeds away down to the levels you talked about, below 30, and meanwhile, we could be up another 15 or 20% theoretically in the broader market. Is that concerning, or are you willing to miss that move?
We tend to trade the chop a bit for the accounts where it makes sense. So we'll short and cover. There's a stock, I think, I can't even count how many times last week I've done that. So we will do that to make some money for clients when, again, it's appropriate. And as you're saying, though, it could go up, but it's never in a straight line. So you get this really choppy, volatile environment, and then you have to be a little bit more tactical. Add those positions on those days that are defensive, that is, on days like today, and then trim those longs and have a little bit higher beta. And that's how you get through a period where there might be some upflow, especially since it's quarter end and month end at the same time.
Hey, Nadine, it's Tim again. Yeah, thank you for joining us. And as you look, though, at the subsectors of the market and trades that have worked, especially during either growth-constrained environments, certainly growth over value is probably what we've seen in terms of triple Qs, NASDAQ 100 stocks outperforming the overall S&P. What are you thinking here? What are you thinking coming out of this whenever you get comfortable? And again, S&P earnings estimates are coming down, but how far down do you need to see them?
We expect roughly a 25% peak to trough, that is, decline in GDP. And the stimulus that you saw going on last week, it's about 10% of GDP, so it's just not enough. So even though people have brought down, let's say, second quarter estimates, they really haven't brought down the back half of the year. We're seeing the consensus estimates are up 6% by the fourth quarter, and that just has to be brought down. So what we're trying to do is, let's say you are investing in tech, invest in those businesses such as, I won't say which ones we've owned, but since 2013 and the like, that might be in the data center business, that benefit while people are working from home, that benefit from an increase in cross-connects where companies have to come together and put their technology systems in the clouds together. We like those types of businesses. But if you're looking like for a tech company that has leverage, that might not have a great balance sheet, that is more cyclical, ad spend, then you're in a little bit more trouble. So just saying technology overall, you have to be very careful. And we invest globally across all sectors, so we do have, call it the favorite, unfavorite positions across all sectors.
Nadine, data centers and also REITs have become a safety play. But Dan, where do you see this market going? What moves do you want to make?
Yeah, so it's interesting. Nadine brings up a lot of good points about some of the new technology that is clearly going to benefit from this kind of work from home environment that's likely to stick around here for a long time. But I think it's really important to remember that some of these stocks, as Zoom in particular, with a 40 billion plus market cap, is kind of uninvestable here too, so there's a lot of themes that are playing out in this market that are pretty interesting. Some sectors seem to be defensive, other ones where there's strong secular shifts towards cloud and data centers, that sort of stuff, it seems great. I think that's one of the reasons Tim brought up Intel before. One of the reasons why it's acting well or outperforming some of the names in its peer group. So, to me, listen, there's going to be plenty of opportunities. I just think if you think buying right now after this 20% pop, after a 35% peak to trough decline is going to be that generational low, I just think you're a little too soon. I think Nadine and our other guest, Emily, brought up some great points about S&P earnings, about recessions. This stuff takes time. The market can V-reverse like it just has in the last week. The likelihood of the economy doing that is not particularly great right now. So I just think investors better be patient for 2020 here.
All right, patience is always a good thing. We want to thank Nadine Terman for joining us, but we're going to toss things over to Emily Roland. I'm going to give you the last word. Emily, what is your bottom line?
Our bottom line, it's really just about positioning in this market, and it's all about participate and protect. Again, we don't want to try to call the bottom here, but we want to engage in this market in a thoughtful way. And for us, that's meant leaning into quality growth. A lot of that is technology. We want companies with strong balance sheets. We want companies with low earnings variability. And we want companies with the ability to benefit from this spending that's going to happen after this. It's probably not going to be that big bounce in cyclical stocks that you usually see coming out of recessions. For example, in 08, 09, it was really about the commodity complex. For us, the focus here is really on technology, and then pairing defensiveness, areas like consumer staples and healthcare, we think would be a good way to kind of barbell the approach to this market.
All right, interesting point of view there.